Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, March 28th, 2017. I had a request from a member in the trading room for an update on gold and the gold mining stocks, GDX. It's been a little while since I've done an update, and I'm more than glad. If you're a member of the site, drop me a line in the trading room if you'd like an update, particularly on something that's popularly traded like gold. I mean, gold and the gold mining stocks are probably right up there with the stock market as far as interest and how many people are trading those and always interested in the next direction in gold or the mining stocks more so than any other asset class that I can think of, especially bonds, most commodities, anything else. So again, don't hesitate to bump me or nudge me if it's been a while and you want an update on gold and GDX. And the other point of that is that keep in mind, my analysis, what I focus on, what I'm following, you'll notice sometimes seems all over the place. One minute I'm all over gold in the mining stocks. I'm active updates, multiple updates a day, either on the front page and or in the trading room. Then I may back off it for weeks or even months at a time. And that's simply because I move on to where the opportunities are. There is not a single asset class, stock, sector, commodity, precious metals that can continually produce, objective profitable trades. In other words, my trading style is I wait patiently for the charts to come to me. I wait for clear technical developments. I look for trade setups with clearly defined entry points, exit points, meaning price targets or stop levels, and ideally technical patterns, whether they're bullish or bearish chart patterns, key support levels, confirmation via the price momentum indicators and oscillators and things like that. So that's how it works. But again, don't hesitate to nudge me if you'd like an update. If I don't see much, sometimes my reply will be as simple as that. I just don't see anything in the charts. But with that being said, there's enough right now in gold and GDX. And those of you that have followed the site for a while, in my opinion, any analysis on gold and or the mining stocks is incomplete without looking at where the dollar is going to confirm or refute that analysis. And the reason for that is most GDX, to begin with, the gold mining ETF, will always follow gold. There's a very, very tight positive correlation, always has been, and there always will be, meaning gold goes up, the miners are going to go up with it. I'm not talking day to day. I'm talking the trends over periods of weeks and months. And if you don't doubt that, let me not spend too much time on it. Just pull a 10, 20-year long-term chart of gold and overlay GDX. If you have to go back 20 years or more, use the HUI. It's an index, HUI. Gold Bug Index is going to give you pretty much same chart as GDX, just with a longer trading history because it's been around a lot longer than that ETF GDX. And then as far as a dollar goes, historically there's been a fairly tight inverse correlation between gold and the dollar, meaning when the dollar goes down, gold goes up and vice versa. Now, I say a fairly tight because there are periods I've noticed over the years of weeks and even months at a time where that relationship completely disconnects and you'll see gold and the dollar moving up together. But overall, on balance, again, you can take a long-term chart of gold, overlay with the US dollar, and you'll clearly see that relationship exists most of the time. As such, I try to confirm or refute my analysis on gold, meaning if I'm bullish on gold and trying to make a bullish case, but yet something doesn't seem right because the dollar also looks bullish, poised for a bounce, that's conflicting information, or it may be, and that may give me pause, at least on my conviction on that move in gold. So with that being said, I just wanted to really try to impress, especially those of you that are relatively new to trading or investing, if you have asset classes that have a tight correlation, best to chart them together. And the most profitable or the most successful trades, I should say, come when the charts are in alignment. In other words, if you can make a case for a drop in the dollar and a strong case for a rise in gold, and GDX confirms as well, and it's coming down to a key support level or just breaks out of a bullish chart pattern, there's a good buy signal. All right, so let's dive into the charts and tell you what I see and really what I don't see here. All right, this is a daily chart of gold. One of the things that I've highlighted in recent weeks, maybe over the last few months on a few of the updates, is this resistance zone up here, these three lines. Any of the horizontal lines on my charts are resistance if above current prices or support when below. Doesn't necessarily mean it's all inclusive, meaning there may be other levels in here I didn't put. These are just lines. I haven't updated this chart recently. I just wanted to get this video out today. But a level that I've had and I've highlighted in recent weeks is this support zone here. These three horizontal lines in close proximity right here. If you look back, going back over the last year and a half or so, you'll see numerous reactions around that level. That's what really makes it a support zone. You have gaps, reactions, and so the support zone runs about the distance between these three lines here. So really what you want to look at really more so is the top and the bottom line. And I believe I pointed it out most recently on this tag over here. At the time we had what I call an overextended run, quite the rally into that key resistance zone. And I can't recall if I personally shorted gold or GDX or mentioned it on the site. Honestly, but I believe I mentioned that the RR was very unfavorable at that time due to two reasons. We were overbought, number one, and at resistance. And I can think of no other reason to either not add to gold or maybe prepare for a quick pullback trade on the short side, or maybe even more of a longer term swing trade. Either way, we had this uptrend line here that was broken at this point right here. That triggered a sell signal that brought us down to this 114-ish support level, and from there we reversed. And once again, we've come full circle. So we're back to that resistance zone, right about where we stopped before, a little shy of it. I think let's clear those lines out. Looks like we stopped right around the top of the resistance zone last time, and we're about in the middle of the resistance zone now. But something to note is gold is pretty stretched, or was pretty stretched just to get up here. Although this move right here wasn't as big as this previous move, we did have a little reaction, a little flagging action there, pullback. That helped to alleviate the near-term overbought conditions, and then that was followed by another thrust up. In this case, we've had a nearly vertical run with very few, if any, give back, meaning red candles or consolidation. So although we're not overbought, at least we're not all the way up to the 70 level on the RSI here, which would indicate overbought on the daily chart. We're most certainly overbought in the near term, the shorter term time frames when you get down to the intraday charts. So once again, we have gold at resistance while overbought. While resistance is resistance until broken, and in which case that's usually a buy signal. I can tell you right now that I wouldn't have any interest in going long gold if it were to break above the top of this zone in the next few days or so. At the very least, and that again, that would be on face value a bullish technical event, but at the very least, what I'd like to see is a little bit of consolidation, either in time or maybe a pullback in price. Gold comes back in a little bit, works off those near-term overbought conditions, and then has the energy to blast on through there and make it up to this next resistance area right here around 125 or so. So again, I talk about corrections. They can manifest in two ways: either time, meaning a sideways consolidation, or price, or both. And if I had to take my best guess right now, and this is why I don't have any positions in gold or GDX, nor have I recently, my best guess is we're going to see something like this, that we might be looking at maybe a little bit of a sideways trading range. We had one back here in early 2016 that lasted for at least a few months, a couple months there, popped above it, and then continued on within that trading range. And finally we cleared it and then had a nice run. There's another trading range, consolidation range. And all these do is they serve to frustrate you. Whether you're long or short, you're going, green, red, green, red, green, red, green, red on your positions, and it's no fun. So it's I try to step aside when the charts aren't clearly bullish or bearish. That's one thing I've learned in trading over the years, that less is more when it comes to trading. Be very selective. Don't try to force a trade. If you can't make a clearly bullish or bearish case on a stock or security or any instrument such as gold or the mining stocks, why trade it? There's a lot of other things out there to trade. There's commodities, there's stocks, there's different sectors within the stock market. So anyways, just want to share those views and let you know that very near term, I don't think the risk reward is attractive on the long side, nor do I really have any interest in shorting gold or the metals or the miners right now. One other thing to note on this chart that I didn't cover, one of the trend indicators that I like to use is the PPO and or the MACD, and I'll talk on the difference between the two. They're very similar. Sometimes you'll notice down on my daily charts or even intraday charts a MACD, and sometimes you'll see a PPO. They're virtually, there are some differences, but they're closely related, and as you can see when you look at the two, they nearly mirror each other on this chart of gold. Why do I use one instead of the other at times? Well, when you have, in the example here, gold has moved up from a low of about 100. You can see down here, the low was about 100 over the last 2 years. It's a 2-year period. And the high was about 130. So that's about a 30% range from high to low, which is relatively small. Therefore, a MACD and a PPO will work the same. You take a stock like, if you're a gold member, you've seen a lot of posts in the last couple months about USRM. Tiny little, fraction of a penny. We started highlighting this one. I highlighted it first. Somebody asked my opinion. It was 4 cents at the time. I'm sorry, 0.004 at the time. I put up a chart and said it looked good on a break of this trend line here. From there, the stock has run up 3,106%. And that's, I didn't misspeak. That's over 3,000% return. It went up from, 0.004 cents to 14 cents a share. It was most recently, after the 6-cent level, the 4-cent level where it was first highlighted. It was highlighted again as the next objective long entry on a break above 006. Posted booking profits here at T3. It got a pullback. Bull flag pattern, which was posted. It broke above the bull flag pattern. It's running. Now, where am I going with this? Look at the PPO down here. You see the negative divergence? I posted an update on this chart this morning in the trading room shortly after the open or just before the open. I think it was after the open. And you can see the negative potential. I called it potential negative divergence because the PPO is still pointing up. But if it turns down soon around this 12 cent resistance level, you'll have negative divergence if it turns down soon. That's why I call it potential. It'll be confirmed when we have a bearish crossover. If that bearish crossover on the PPO occurs at a lower point than this previous peak, and you'll see the RSI turn down as well. Now look at the MACD. Compare the MACD. The MACD is flattened out. You can't make heads or tails. The MACD is completely useless when you have a security with a range, again, from high to low on the scale that I'm using here. And I have to go to the left of the chart. So the lows here, about 0.0019, all the way up to the highs here. You can see the pop-up box. That is 102,806,000%. That's a huge price range. Therefore, a MACD is rendered virtually ineffective or useless. And a PPO is much better for identifying divergences, and you can see the separation in the line because the way it takes into account, stocks with a high move. So I didn't want to get too far off on that. I just want to let you know that that's what I'm looking at. Now where I'm trying to segue into is how I use the PPO and or the MACD as trend indicators. It's a very simple and fairly effective method, and that is when the signal line, which is the 9 EMA, the white line on the PPO or the MACD on my charts here, when those lines are above the 0 level, as it crossed over here and it remained above to this point, the trend is bullish. So here's a bullish trend right here, and you can see above, gold was in a bullish trend. We had a little bit of a whipsaw, but then it stayed bullish all the way to about this point here. It crossed over and remained bearish, and you can see it kept you short most of that move there. So it does a great job of defining the primary trend, and I wanted to point out that, like with many indicators, the zero line is your trigger point. Again, bullish when the 9 EMA is above, bearish when below, and that zero line often acts as support when tested from above, as it did here. So it's keeping, right now it's telling us, and it's turned back up after making a perfect tag of that zero line, it's telling us at this point in time at least that the primary trend remains bullish. Hence the reason I have no desire to short here, even though we're overbought at resistance. You can see to the example I just mentioned, how we found support here when tested from below. Look how the zero line acted as resistance when tested from above. So again, nothing's perfect. You have a few whipsaw signals, but on balance, it helps keep you on the right side of the trend. And so there it is. That's my analysis on gold. Spent a lot of time there. Let's take a quick look at the weekly chart, and I'll move through the rest of this video a little faster because you guys have heard me say this many, many times. Where gold goes, GDX will ultimately follow. And GDX, that's my favorite trading proxy. When trading gold, I like to use the miners because if I get the call correct on gold and I can call a 20-30% plus move in gold, I'll make 50, 60, 70% or so on the miners because they're going to move up anywhere, it depends, 1.5, 2 times or more the move in gold. And that cuts both ways. If you can catch a correction in gold, gold drops 10%, 20, 30%, you're going to make, 2 or more times that on the miners. And again, you can just overlay a chart to see that correlation over the years. So this is the longer term outlook for gold, which is still bullish in my opinion. We had these bullish divergences, long-standing multi-week bullish divergences. You can see here at the lows, gold broke out. There was this descending price channel, almost like a falling wedge pattern. We had a major support level. You can see all the reactions back here. And that was really the lows. It has been the lows that put back in late 2015. And so far they've held. We went on to break out above that downtrend line, a well-defined downtrend line. We back tested, and that was a successful backtest with gold moving higher. The next longer term buy signal, we have to take out those previous reaction highs. What would be bearish at this point, being that we've already back tested that level once, and this is a reaction low, would be a move below there. So to try to just quantify it for you guys visually, and I know these are big ranges, and it may not help with, right now if you're in gold, at a position in gold, but those are the levels to watch. That would certainly be bullish if we take that level out, and it would be bearish if we took that level out, and quite bearish if we took out the 2015 lows. That will have negated a lot of the bullish developments in the last year or two here. So let's just take a look at the 60-minute chart real quick. In my recent updates, I was highlighting for a while this uptrend line. See this purple uptrend line? If you look at the 2 purple trend lines that define a bearish rising wedge pattern, I should have extended these divergences here. We had negative divergences, and I pointed it out at the time, and you can see the notes there. I said that purple trend line defines the bottom of a potentially larger wedge. Either way, a break and a close below would be bearish. Well, we gapped down, back tested it, perfect TA 101. I mean, almost perfect back test, a little shy of it. In fact, I could have tightened that trend line up a little bit to capture that last reaction low, and then it was a perfect back test. So we went on. That was the measured target for the wedge down to 113. You don't always have to hit those. Sometimes you exceed the measured target. It's just a rough guesstimate of where the wedge is going to play out to. And you could see we moved down probably 80% or so of that. Found support just above this 113.85 support level, reversed, but we've come back up and we're challenging those previous highs, which is resistance. I don't see a whole lot on the price and momentum indicators and oscillators and trend indicators. The trend, again, even on the 60-minute time frame, is bullish because it's this 1333 histogram is green. So again, I have no desire to short gold right now, nor would I go long. I'm just standing aside, and I'm doing this video for you guys in this trade. You can take a look at these. These are levels here. I may have to update this chart. This level I had, let me just de-highlight the color. It's not very significant. Usually I color code these levels when they're more significant, but we've traded through that level enough times. So right now the most salient levels that I'm watching would be the recent reaction high around 120.32. Even if we pop above it again, we're still right at the upper end of that daily resistance zone, and we're quite overbought. And any of these levels down below. All right, let's look at a couple other things, and we'll wrap this up. UUP, this is the US dollar ETF. I believe I made mention recently, and I know I have in the trading room. I can't remember what front page posts were made on this. Pretty well-defined trend line. You can see this trend line right here that I'm highlighting. We broke down, back tested, and while back testing, there was a minor uptrend line, and that formed a rising wedge pattern. We broke down, and the move has been impulsive lately. And that sparked that rally in gold. I even updated this yesterday in the trading room. At least I didn't put a chart, but I explained what had happened, everything I just talked about here, and that we were below this support level, but that I wouldn't really the dollar, has moved down too much too fast, just as gold has moved up too much too fast. Again, this drop in the dollar mirrors that recent rally in gold, and it's no coincidence. You remember gold? Here, I'll show you the chart. Remember I told you we stopped at the top of the support zone, pulled back, and had another ramp up. Again, you can see this is just gold in reverse looking at the dollar chart. So we shot below that previous reaction low in the dollar. There's that support level, but it wasn't convincing enough, and it was only one day. And now we're challenging that level as I talk. We're at 25.63. You can see I had that line at 25.64. So essentially, we're right on it. We are now back on support, and if we close back above it, then that was just a false breakdown. And keep in mind, this is the dollar ETF or ETN, exchange traded note or exchange traded product. They do their best to track the dollar index, but there's some tracking error always involved when you look at the ETNs. So near term, again, I think a little bounce or at least a little consolidation. Maybe, I'm not crazy about it, but a possible head and shoulders pattern in play here. There's your left shoulder, there's your head, and there's your right shoulder. And you'd have a neckline looking something like this. So the symmetry isn't perfect, but the form is there, so something to watch. And if that breaks down, that would be bearish. Now I'm going to give you my take on the dollar. Longer term, I do have a little bit higher conviction. This is the dollar index, DXYO or DXY, same as the USD, US dollar index. And here's a nice, fairly well-defined trend line. We've just recently broke below it. There's that inverse head and shoulders pattern. You can see, I'm sorry, it's not inverse, it's a regular head and shoulders topping pattern. So something to watch. And most notably, we just recently broke down below this trend line here. Quite a few reactions, pretty valid trend line. We also had recently broken out to new highs here, and we failed that breakout. So bearish action all around. And let's look at the weekly chart. This one speaks a little louder to me as far as where the dollar's going. And remember, where the dollar goes, gold is likely to move inverse. So this weekly chart clearly looks bearish to me. What I see right now is I see the US dollar index, and this spans back a decade here. I see us overbought. You can see we recently hit that 70 level right here. Overbought with a divergent top. This is negative divergence from that previous peak. Here's the PPO, and the PPO does a much better job on a weekly time frame because you have much larger price swings than a MACD. So I'll almost always exclusively use a PPO in lieu of a MACD on my weekly charts. What happened in the past? Last time we had an overbought divergent top, well, that was a huge drop. I use a log scale, so don't underestimate the scope of that drop. It's roughly, I can't grab the exact level or it'll move the trend lines. That's about a 17, 18% drop in the dollar. That's a big move. And another 17 or 18% drop. There was a divergent top. We came close to overbought, and there was still a nice correction in the dollar. So this is TA 101, guys. Pretty simple and effective. Look for overbought and or divergent top, especially when you get the two together and you're looking at an unfavorable outlook for the dollar, to say the least. So I'll make my outlook for the dollar. I don't mix words here. Longer term, I'm bearish and wouldn't be surprised at the very least to see us come down to this trend line, but more than likely come down to that $90 level, and that's quite the drop in the dollar. Remember, dollar index, that's a basket of currencies. That's another, from where we've already come down, almost another 10%. So that's longer term bullish for gold. I just don't think the timing's there yet. We could slide straight down and gold could rocket up, but longer term, I see nothing but downside in the dollar here. If the charts change, so will my opinion, but that's that for now. All right, GDX, and then we'll wrap up, because this is the instrument I know most of you trade, including myself. This is a weekly chart. We had a very strong, nice, clean, bullish divergences at the lows back in gold bottomed in December 2015, and GDX just bottomed a few weeks later in January of 2016. Huge rally since, took out trend lines, resistance levels, but it had a heck of a run, and it needed a breather. That was a quite stretched, overbought run right into resistance, 150% return. Let me just kind of put in perspective what I just told you a minute ago about gold. Give me a clean board here, and I'll show you the move in gold. A lot of dirty boards. There it is. Gold went up 30%, again, off the lows back in December. I'm just using, if you look at the pop-up box on the bottom, you can see what I'm looking at in green. It says plus 29.6%. So a 30% rally in gold, which equated to what I just said, I think 150% rally in GDX. So there's proof of what I said earlier about getting the call right on gold and simply using the miners as a leverage play on gold. That's all it is. So, why trade? Why settle for a 30% move when, if you're confident on your move in gold, you could add 150%, hypothetically, just catching the lows to the highs. But you'll see the same thing in reverse when gold falls. So longer term, the charts are still constructive. Something giving me a little pause. Again, I talk about the PPO, the trend indicator. And here we are. Recently, we're challenging from below. We did cross and we bend down below, and you can see this PPO curling over now and turning down just shy of the zero line. So, it told us back here all this time. It said the trend was bullish in gold, and in GDX, and it was. At this point, it said, get out, the trend is bearish, and barring a few brief whipsaws, it told you to stay short throughout the entire bear market. Here, it said, get long, the trend is bullish. But this gives me pause, and it doesn't jive with gold right now, and that, again, plays into the fact that I have mixed opinions and not very strong convictions on gold or the miners. So I'll give you the daily and 60-minute charts, and we'll wrap up. Here's a daily chart. Again, something to be concerned about. The PPO and MACD, those trend indicators work just as well on the daily, weekly, or just about any time frame. And so here it is. Also on the daily chart, the PPO is below the zero line, and it's challenging that level from below, which is resistance until and unless taken out. So right now, it's giving us a warning sign. So I think, again, my preferred scenario is just some choppiness for a while until gold and GDX, they figure out which way they want to go. And, longer term, I'm bullish because I've made the bearish case for the dollar. So I think ultimately, maybe after we, just have a little sideways basing action, consolidation, and again, you want to confirm any breakout in GDX. You most certainly want to confirm that with a breakout in gold and ideally a breakdown in the dollar. So there's the levels to watch. Obviously a move over this previous reaction high here. It's about 26, I think. And, be open to all possibilities. My analysis might prove wrong. The charts may change. But as far as where we're going right now, looking at the RSI is right down in the middle, right on the 50 level. That's indeterminable. When you're overbought, there's a good chance for a pullback. We got overbought. You see a level of a reading of 70 or higher on the RSI. That the risk reward is no longer very favorable to the upside, so you get a pullback, just like you get we had here a series of consecutive divergent lows, overbought readings, positive divergence, and that led to that rally. So right now, I can't make heads or tails of this. Like I said, guys, it's coin toss to me where gold goes and GDX, and I don't want to be caught in a sideways trading range. So I think that's it. I don't see any reason to get into the 60-minute charts. We're just moving around, grinding around, and If you're trying to swing trade day in, day out, here's my trend indicator. It doesn't do a perfect job. GDX is kind of whippy, but for the most part, when this 1333, that's just the EMA pair, the 13 and 33 EMA. I made a custom histogram. And so when the 13 period EMA is below the 33, the histogram crosses red. The trend is bearish. As you can see here, it was all pretty much, it signaled there, had a brief whipsaw, and it caught most of that downtrend there. And it's been bullish since this point, and the trend has been up, but you can see some divergence there. I'll draw it out for you guys here. So this is what I'm watching now. If I had to take my best guess, I'd say we're going down. We have negative divergence on the 60-minute time frame. I'm drawing it out for you here. So you want to look for a bearish cross on the trend indicator, bearish cross below the 0 line here. That would be sell signals. Maybe a trend line like this will drop below this trend line here. And if you're looking where to buy, if you just want to trade within this trading range, I can see some decent support down here. I may have to move these lines since I first added them, but something along these lines here, something like that if you feel like trading it. All right, this has been Randy Finney with Right Side of the Chart, and I hope you enjoyed it.